back to another exciting edition of the Road to Financial Independence. I'm your host, Mike Risk, from the president of CPS Investment Advisors. And always, I'm joined by my partner, CEO of CPS Investment Advisors, Peter Galacco. Hey, Pete.
Hey, Mike, how you doing?
Doing terrific.
It's going to be a good one.
It's going to be a good one.
We're talking taxes.
Oh,
I love
What's
taxes.
more exciting than
I
taxes?
know. For a CPA, let's do it.
That's right. That's right. This is probably our highest rated podcast ever.
I know.
I imagine. And but this year there is a lot of interest in taxes. I think one of the themes heading into 25 that we talked about as far as market updates and as it relates to the economy was the potential for a tax bill over summer. And here we are.
Yeah, well, I don't think we got much of a tax break. We just got the tax breaks that we got a few years ago permanently put in. And, one thing that I talked about over and over again, you could hate this bill across the board, but if we didn't pass these tax cuts, it would decimate our middle class, because everybody would be paying substantially more taxes. The tax rates would go up. The brackets would get a lot smaller. So people would be paying a lot more tax. And what this does allows people to continue to use the money that they're using. Now, there are some things in the bill that, will bring people's tax rates down. And that's good too, because we need more money being spent in the economy.
That's right. That's how the economy works.
That's right. The velocity of money through the economy. So, with people have more money in their pocket to spend, means that the economy is going to do better. Because as Americans, we know we spend everything. Well, we spend about 110% of what we bring in. So if that 100% keeps going up, then we're going to be spending more. So
that's right.
It's going to be exciting.
Absolutely. And as much fun as you and I love to talk about taxes, nobody, and I mean nobody, loves talking tax more than our tax director, Levi Gruber. Levi, welcome to the show.
Thank you for having me. Glad to be here.
Yep. I like the little glare coming off the forehead.
That's
Looks
right.
like we got all three bald heads in here.
That was part of the interview.
That's right.
when we're looking to hire a tax director, must have the same type of hair style as Pete and I.
Yeah, we use the same barber.
I fit in.
Well, Levi, we do appreciate you being here with us. Certainly, I think you've been doing a lot deeper dive into what's been going on with the tax bill and some of the updates. And I think let's just head into this. I think one of those campaign promises that got a lot of the headlines was certainly the tips and overtime discussion. So whatever happened with that, how has that been affected?
Yeah, so that was one of the, obviously, and is still continued to be one of the big topics. No matter where you're at, everybody's talking about this. So that did land in the bill. There is on tax or on tips and on overtime, there's a $25,000 exemption. The tips is cut down into individuals. So the tips is going to be, and it has to be qualified cash tips. So there's a lot of talk out there that isn't being clarified, right? So it's qualified cash tips, and that is effective.
So something on the credit card they don't get.
So that is one of those things that has not come down yet from the IRS. In the language of the bill, it says qualified cash tips, and a lot of people are asking, so does that qualify if I'm scanning my card? And it's like, well, we don't know yet.
Oh, wow.
But that is one of the pieces of the language, is it does say qualified cash tips.
It's interesting because most cash people they probably don't report anyway. I mean,
Of course they do.
I don't think they report much, but every
$5 bill is, there's one in the pocket and one reported, right?
So if whatever does qualify, what are we talking here on tips in terms of exempt from tax?
Yep. So if there's a $25,000 per year per taxpayer. And there is a phase out with this, right? So, and I don't know that we're going to run into a lot of the phase out, because it's a phase out at $150,000.
Is that for a married couple?
That is for the single person.
Oh, wow.
It is
So it's
a
pretty
high
high.
phase out. Yep. And then it's $300,000 for a married
Oh,
couple.
wow.
Yep.
Okay. And is that, so you said it's so is overtime separate, or is that 25 total?
Overtime is a separate one.
Okay.
Yep,
So,
overtime is
so talk
separate.
about overtime. I know that got a lot of publicity.
Yep. So that is $12,500 for single, or $25,000 for a married on the overtime piece. So the overtime is a little bit different because they keep just saying $25,000, $25,000. But if you are single, it's only $12,500 for overtime as a single.
Okay.
Can you double dip?
You can double dip. Where was that?
Yeah,
There
so
was,
if you're working a 60-hour a week job and then you bartend on the weekends,
Yep.
you're going to be able to really save a ton on taxes. Sounds like.
Yep.
Get a lot more cash flow coming in.
That's right. That's right.
That's awesome.
Yep.
All right, sweet.
There's phase outs. There's the the tips piece, though, there is another qualifier, and this is one of the things the IRS has yet to release, and this is part of the bill. They have to release it in the next 90 days. It was before January 1st of 2025, what industries regularly receive tips. So if it's not any new industry, and it's no new industry can come in and say, hey, we receive tips. It has to be
So we can't
qualified
pay
by
our
the IRS.
employees tips.
That's
Right.
right. Our clients can't tip our employees
exactly
for
right.
doing their
Yep.
taxes.
So that, because we all know how that was going to shake out, right?
Oh yeah.
Every industry was going to come in and start saying, we need tips, we need tips.
We
need
wouldn't
tips.
not really, but overtime works, doesn't it?
And they did add beauticians into that. So as of right now, because they weren't part of the regular specified service trader
interesting.
businesses, so they did come back and say that is historically they've been receiving of tips.
Awesome. Well, appreciate getting right out of the gate on that one. I think that was a high profile provision. Another high profile provision of the tax bill that was a big campaign promise also that probably affects a lot of our clients was the Social Security. There was a big promise, to cut or not tax Social Security. Explain how that's going to go down and what came out of the bill for this.
Yeah, so that was one that was shaken up even still last month, right back in June, as this was going into Congress, going to the House, going to the Senate. There was a lot of shakeup there. Nothing came in that directly impacted Social Security wages. So what was is still what is.
Okay.
However, with that being said, they did add a provision, and this kind of goes back to the historical personal exemptions. So if you were 65 years or older, you get a $6,000 deduction. It is a personal exemption. So they are the only ones that get the personal exemption. If you're 65 or older, it's $6,000 for single and $12,000 for married filing.
Okay.
So there is a provision there that is supposed to help offset that Social Security income is what that was
So
hard.
if you're told, let's just say you only had Social Security and it was $50,000 a year, then that 50 and I'm married and we're 67 years old, I'll take that 50 less the 12. So now basically my taxable income, so to speak, would be 38,000. Okay.
Yep. And then there's few other pieces that go with that, right? They did permanently increase the standard deduction. So that was part of the bill as well. That was supposed to revert back at the end of this year to the old rates, which I think they were like $6,000 for married filing joint, and the new rates are going to be $31,500 effective for 2025. With that, there is still another, if you don't itemize and you're 65 years or older, there's another little caveat there that, again, non-itemized people 65 years or older are going to get an additional $2,000 if they're married filing joint,
Oh, wow.
plus the $12,000. Wow. So in total, I mean, they're making out like bandits, right?
So the new standard deduction you said is 31,500
$31,500
plus
effective this
you
year.
get 2,000
Plus.
that's for a married couple for being over 65.
That's right.
So that's 33,500 and then another 12,000. That's almost $45,000
And deductions.
of deductions.
It's $46,700.
46,000.
This actually comes out to $3,200 for the personal exemption because it is indexed, and that'll be indexed every year.
So that's going
What's
to put
not-
more money in people's pockets.
Right. So you don't even, so there's scenarios. So it's not tied to Social Security. So there's a scenario. Let's say we have a client waiting until they're 70 to take Social Security, but they're over 65 and they're under the income levels phase outs.
Yep.
So they're still going to get this 12 even though they're not collecting Social Security.
That's right.
Oh, okay. That's
Now, does the Social Security keep the same tax rate? So the first X is not taxable, then 50%, then 80%.
Yep.
So really, it's not the 12,000 doesn't offset all of your Social Security. You're not taxed on all of your Social Security. So this might even be for some people a bigger deduction than what they would be paying in
That's right.
Social Security tax.
yeah, it could wipe out. That's right. That's right. It could wipe out most or all of the Social Security.
So that brings up a nice planning opportunity. Roth conversions. So, if you got an opportunity where you're not paying a lot of tax now, you could do some Roth conversions, keep your tax down later on when you'd have to take your RMDs.
And this personal exemption, the issue that we're going to run into with that is this is only good through 2028. So it's only got a 4-year tax benefit, right? 25, 26, 27, and 28. It reverts back to not being existent.
This is that $12,000 we're
It's that
talking about.
$12,000, that personal exemption.
What's that? Well, why till 2028?
Well, it wasn't part of the other bill. And a lot of times what they do with tax law is they give it a run out to see
That's
how
right.
it works.
Right.
If it doesn't work, they can always not.
They
I
have
think this is
another
what they're
election
gonna
to
do.
fix it. Yeah.
Right. So they're not giving a lot of time. Is this going to be as good as not taxing Social Security? So I think it gives them a little bit of time to figure out, is this the right move?
Trial and error.
Yep.
Yep. A
before they
little
make
bit
it
of trial and error. That's right.
Yeah, that's a good point.
And the other big thing to keep in mind with a lot of what we are talking about is specific to federal, right? So the states haven't, state legislation doesn't happen until January. So a lot of these things that are effective for 2025 may not be a benefit that individuals will receive at a state level. So
wow.
fortunately here in Florida, we don't have a state income tax, but we're going to see plenty of clients that have state income tax that, you know, what's happening at the federal level, we've got to adjust it back out and add it in as income or whatever at the state level.
So if they don't, right, that's an interesting point. So if they don't adjust, some of these deductions will actually be taxable at the state level, and the states need to factor that into their budgets.
That's right.
So some of these states that are underwater might not be on board. Yeah, that's an interesting point.
Yeah, and those are the things that we've got to watch because sometimes the states will try their best to make it retroactive, but it may not get passed until March.
Right.
And if we've already filed an Indiana state income tax return that has a legislative change that's retroactive, now we've got to go back and amend that return to take the benefit of the
Yeah,
new
that's
law.
not a lot of fun.
No,
We don't like amended returns.
that's why we like Florida,
Yes.
state income tax, so we don't have to worry about it to some extent, right?
That's right. Well, that's a great segue to the next, what I would consider one of the high profile discussion points. And that was the SALT.
Oh, I was just going to say, we need to talk about the salt.
Salted up.
Oh, yeah. I thought that was in tax law, you know, you look back and you say good, bad, or indifferent. And I just had a giggle with this one because there's some states that really got hammered.
That's
with
right.
this.
Oh, yeah.
Hammered because they've got state income tax that they pay and you're limited to $10,000 and they're paying huge real estate taxes.
And income tax.
Yeah. So, you know, they could be paying 50, 60, 70,000 in taxes and get a $10,000 deduction. That hurt a lot of people. Now, that's, if you look at it, it's a lot of your wealthy people.
Sure.
We don't tax the wealthy, but I don't think across the board that was the fairest tax, that fairest change that they could have made.
Yeah.
And even though I liked it because that taxes the rich, I just didn't think that it was the right way to go.
Yeah.
So, you know, this increase from 10,000 to 40,000 is okay.
It is. And again, this is another one that is effective for 2025,
Okay,
right?
so that's
The
this
increase
year.
is effective for this year. This is another one that will expire in 2030.
Yep.
So beginning in 2030, it reverts back to $10,000. So this is another one that we got to keep our eyes on. And again, there's phase outs. There's other adjustments that come in. It will not revert to lower than $10,000 though. So if you start working through your phase out, which as a married filing joint is $500,000. Actually, I think that's across the board, single and married filing joint. It's $500,000. As you start working towards that, you will phase out, but you will never be reduced below the $10,000.
So you get the
deduction.
10 regardless.
You get the
Okay,
10.
so it went up to 40.
But not everybody's going to get it.
It'll
But if
reduce.
you made $1 million, you probably get the 10,000.
That's right.
Okay.
Yeah, that's right.
So, and
Oh, that's
So that's
interesting.
catching
That's very
the rich.
interesting.
That's catching the rich.
yeah, it's almost like, hey, we're going to give this back to you, but
Whatever
not.
rich is.
But not. You know?
Yeah.
Well, again, so the facts, it really targets the middle class, let's say, the
For the
middle
benefit.
earners.
Who live in the states
Because
that have higher income
correct,
tax.
right.
Well, we saw the limitation when I was in Idaho. We saw the limitation all the time. You know, somebody has a taxable income of $100,000. State income tax in Idaho was 6%. So there's $6,000. You take in some sales tax. You take in, property taxes, and you're over the $10,000 mark in a real quick hurry. But you're limited. So, and you could be right at that verge where if you got to take your entire SALT, your state and local tax deduction, you might be able to itemize, but yet you were limited.
That's right.
At that
the
point,
$10,000.
to the
Oh, yeah.
10,000, and that that's a $100,000 earner. That's not a
Mega Million.
not a mega
Right,
millionaire.
right.
So I'm really hoping that we do see this benefit come into the class of where it's really supposed to help.
That
them.
makes
Good.
sense. Yeah,
That
and that's
does
good.
make a lot of sense.
Thanks for. I think I just jumped into the SALT, and I realize we talk about this stuff all the time. Thank you. So yeah, that's a state and local tax deduction. We're talking about property taxes, state income tax, sales tax. Those are your three big ones where you could accumulate them.
Oh yeah.
And then take that as an itemized deduction. So
And with that, so since we're talking about this, let's just touch base on one of the other things that is in this bill is there is now, because a lot of people won't itemize, right? So this is an itemized deduction that was limited, the SALT is, but with the itemized deductions is your charitable contributions. So there is a new a new permanent, I believe it's permanent that they made this permanent, is there's $1,000 for single filers. So if you donate cash to a not-for-profit organization and $1,000 or more, and you don't itemize, you will get this $1,000 deduction on your return regardless. So, and that's for single filers. Married, it's $2,000. So that is one of the
Well, that's
changes.
great.
And that is, again, I think I told somebody earlier that, about 50-50, but everything we talked about is effective for 2025 so far. This is effective for 2025. So
Okay.
that comes into play this year, which is another big thing that, a lot of people don't itemize. They might not have mortgage interest.
So that was, there's a few years ago that
that's
people
what I
got like
said.
$600
During
or
COVID.
something.
Yeah, during COVID, yeah.
So now this is a, automatic $1,000 deduction.
And to your point of testing out, right? This might have been one of those points of testing. Let's see how this works, and must have got good feedback or whatever. I don't know what the IRS looks at in terms of.
And again, to untangle the lingo, because we do talk in the itemized deductions, standard deductions. So basically, if you itemize, you have medical, mortgage interest, real estate taxes, and charity. I mean, those are your big four, right?
That's right.
And so that's what we're talking about here. And so, and what you discussed earlier was, if those four things are below the 31,500, then you're going to just take the 31,500. And so if that's the case, but you still donated $2,500 to a charity, now you're going to get the standard 31,500 and also the $2,000 charity donation. So I figure that's a nice way
pretty
for
nice.
nonprofits.
That's right.
That's another $2,000 you can potentially take as a
that's right.
deduction.
No, that's great. That's great.
exactly right.
Very nice. Okay. Well, great. So yeah, I think that would affect a lot of people out there that.
And then also non-cash contributions. So if you've got stuff in your closet that you haven't worn in
Goodwill
20
donation.
years,
Salvation Army.
Salvation Army, Goodwill.
That does not go towards the $2,000.
No.
No, only cash donations.
Only
It's
cash.
That's right.
So that way you got to have a yard sale. That's
right.
And then donate the cash.
There you go. That's the better route. That is the better route. And just another real quick thing that is in this bill saying on the donations is there is now that, to the negative side, there is a floor now for charitable donations, and it's 0.5% of your charitable base, which is usually your adjusted gross income. So somebody that has adjusted gross income of $100,000 and they donate $5,000, there's a floor of $500 that wouldn't qualify towards that itemized deduction.
So it works kind of like that medical, not to
exactly
get too
right.
deep in the weeds, but basically
Yes.
the point being is some of your charitable, if you itemize and you do the charitable donations, the first X amount as a percentage of your income is not going to be deductible now.
0.5%.
0.5%. Wow.
0.5%.
That
one I don't understand. I don't have a theory behind that at this point. I haven't heard a
Yeah,
good
take
argument.
money out of the charity's pocket.
And I don't know if they're trying to just offset that with this $2,000,
$2,000.
because a lot of people that itemize may not have been contributing anyways.
That's fair.
And now they're going to get a benefit for what they have. So,
Well, interesting stuff.
Yeah.
Well, for the sake of getting through some of the highlights of what we wanted to go over today, let's go to the estate tax, because I know that was a big one. The exemption for married folks for the estate tax, that if your estate was worth close to, I think we're almost at 25 million at this point, for married couples, that was exempt from estate tax. That was set to go back down to, I think, 5 million plus adjusted for inflation starting January 1st, 2026. Levi, talk a little bit about what happened with the estate tax.
Yep. So that was renewed, if you will, under it was going to revert back to $5 million. So now we've got a basic exclusion increase effective in 2026. So this one is not effective for 2025. It's still under the Tax Cut Jobs Act. So I think we're at 13,500,000 right now, something along those lines is where we currently are. But effective for next year, it bumps to 15 million, and it will
So it'll be 30 million per
15
couple.
per
That's right.
person. Yeah,
And-
30 per couple.
and it will be adjusted for inflation as well. So that's one that will be moving forward.
Okay.
So that's a big plus.
So that's a big jump.
Yeah, that
we
was
were at 13.61.
okay. Yeah, because I mean, we do a lot of estate planning at CPS and work with a lot of estate planning attorneys, and the whole playbook for estate planning. When Pete and I first started, it's 600,000 and a million.
And we need a lot of life
Yeah,
insurance.
life insurance.
Life insurance
and
out.
trusts and-
Yes.
And then as when this thing came up on board, and now you're in tens of millions, a lot of the strategies have they're not gone away, but they've been tweaked and only affect certain folks. And then, so anyway, yeah, it's interesting that at least for now, I know a lot of people were preparing to maybe have to go back to their estate planning attorneys to redo stuff. Now, maybe public service and now, still always a good idea to have your estate plan checked.
Yes.
Every a minimum, I would think 5 years.
Every 5 years,
Yeah.
you need to be looking at it because things change.
Things change, yeah. State by state, and then certainly with the federal tax law. So always a good idea, always a good to do that.
Yeah, and if your estate is over the 27 million or 30 million, come give us a call because we've got a lot of strategies we can talk about to save on estate taxes and transfer wealth the right way.
That's right. That's right. Legally in the right way and all that good stuff. So we are, it's crazy. This flies by. We've talked a lot of good points here. One last thing, I just want to, there were a couple provisions for Florida, Florida, for businesses in the tax law. Two in particular that would affect more clients than not. Talk about the, I'll use the 199A deduction. You can translate that for our folks and what that means and how, with the importance of that being kept in there.
Yeah, so this is probably one of the things that I was the most excited about. There's two pieces that went into the business side that I was excited about. First and foremost is the qualified business income deduction. And again, there's qualifiers. There's a few different things that go into this, but what it is the income generated by a pass-through business, so a partnership or an S corporation, which can both be LLCs. Right?
LLCs, yeah, we get that question. People think LLC is but
it is.
It's most LLCs.
Yep, that's right. So for the most part, these small businesses were receiving a 20% deduction off of their income, off of their income on the personal tax return. So this was one that was set to expire at the end of this year. And it was made permanent. There was a lot of talk back and forth on what was going to, there was talk about making it 24%. And ultimately they kept it where it was at 20%, which I think is fine. That's good. They added a few other little provisions for smaller ones. There's a minimum. If you have $1,000 of business income, you get a $400 deduction. So it's, there's a lot of good little things that came out of it, but that was one that was probably one of my favorites. The other one, that is actually huge for us specifically even in the state of Florida is the bonus deduction, the bonus depreciation.
Oh yeah, this one's huge.
That came back. That was phasing out. The last few years we haven't been able to take 100% deduction on assets
that you purchased in the first year, right?
That you purchased in year one. It was 80%, 60%, 40%. This year it was going to be 20. That was made permanent back at the 100%. So a lot of our strategies on the business side gets to revert back to some just simple things. Again, this is one of those things that we got to watch what the states do because there is an impact there. On a lot of states don't conform with.
Now, did you tell me that this also applies to commercial buildings?
Yeah. So this is a very specific qualifier. But if you are in a manufacturing, if you are manufacturing goods,
go buy up a bunch of commercial real estate.
Yeah, we can put manufacturing in there too.
Yes. If you are in a qualified manufacturing facility or industry, and you are building a new building, effective started this year, and it's done and in operations by 2030, I think it is. You can take 100% bonus depreciation on that building in year one. Wow. There's some qualifiers there, right? Which we would be looking at, but that was and what's the intent behind that? Well, there's a lot of tariffs that have come in for imported manufactured goods. This is the way of trying to.
This is part of the ongoing theme of bringing manufacturing back in.
Exactly right. Thank you. That's exactly right.
Okay. No, thanks for clarifying that.
That one was huge.
So when you said, just real quick to go back, you said that the deduction for the qualify the 199A deduction was permanent. So let's discuss that real quick. So when you say permanent, that means that it doesn't expire on a certain date, but Congress can always come back and they'd have to enact a new law.
Yep.
To override it.
That's
that doesn't right. So it can be changed. It's just not. It won't expire.
It won't expire.
Absent it changing, it's in effect for.
It's much harder to change the law than let it expire. So making it permanent makes it more permanent. It takes an act of Congress to change that.
Okay.
And to that same extent, the Tax Cut Jobs Act was a run, as Pete kind of explained, a trial and error to see how things were working. And a lot of those laws became permanent, right? So that's not laws, but a lot of those tax situations became permanent with this new bill.
Okay, awesome. And in 60 seconds or less, because I do want to get this in there for us, for our Florida residents in there, talk about commercial sales tax, sales tax on commercial rentals.
Yes. So effective October 1st, if you have a commercial building that you are renting out, there will no longer be sales tax.
And that's for any industry.
Commercial building.
Commercial building,
Commercial building.
commercial real
Yep.
estate.
Yep.
So it doesn't have to be owner occupied. It could be any rent coming in from a commercial building.
Yep. So if you parking lots that you rent out will still be subject to sales tax.
Okay.
But the building itself that you rent out, it will not be subject to sales tax in the state of
Can we
commercial.
still charge the tenant sales tax? And just,
I'm not gonna say what you can and can't. We won't ask some specific questions.
Put it as a line item. That's right. Nice. Well, I think that's a good ending point.
That is, yes.
Before Pete gets any more creative tax ideas. And tune into our YouTube channel or anywhere else where you get your podcast for other additional educational content. We've got a lot of things rolling out here in 2025. Thanks again for watching. And if you'd like to contact us, feel free at info@cpsinvest.com, as well as 863-688-1725. And look forward to doing this again soon. Thanks again. Bye.